Now talk us through market activity today. We had local participants dominating trade yesterday. Was this the case in today's trading session?
Today's trading session was basically driven by three counters. That's East Africa Boris, Kenya Commercial Bank, and Equity Bank. And largely foreigners. 80% of all the trades in the market today were done by foreigners, and 95 to 96% of all the foreign trades were actually on those three counters. And it looks like most foreigners are now moving away just from looking at liquidity, but they're also looking at value in terms of future value, in terms of expansion. If you look at all these three companies, what they have in common is that they are regional. They're not just Kenyan companies focusing for business in Kenya, but they have revenue streams coming from outside Kenya, which is boosting also their performance and making them relatively stable in these harsh economic times.
Now looking at some of the companies out with results, we had Athi River Mining posting a 23% rise in 2011 pre-tax profit. The company is quite bullish about growth in 2012, but did warn that the presidential elections that are due to be held in Kenya in March next year would be somewhat of a hindrance to results going forward. What did you make of those results?
Cement consumption might slow down this year, but not really drop to the extent that it will have a big impact on their revenues. And with a stable shilling on their side also, it plays more to their bottom line. Because if you notice, between their full year results and their between their half year results and their full year results, they managed to reduce their foreign exchange losses by close to 500 million shillings, which is a huge chunk which went now to support their bottom line for last year, for their 15% growth in profit after tax. So you find, yes, they have a reason to be bullish, because as long as the construction is going on, the infrastructure development is going on in the region at large, in Uganda, in Tanzania, in Kenya, they will always have a market for their cement. Because the dynamics of the cement sector is that we actually don't produce enough cement to meet the demand in the market. But there might be a slowdown that will come from the housing side because of high mortgage rates, which are around 24%. The uptake or the uptake of new houses, of new mortgages for off-plan developers will actually reduce. So they might suffer that small impact on their top line from the housing side.
Now looking at expansion, the company is also quite bullish on expansion. They plan to raise a $15 million through a convertible loan this year to finance expansion. What will that loan, what likely impact will that loan have on their balance sheet?
No, I'm not really looking at their balance yet, because in terms of their funding structure, their debt to equity ratio, they still have some room to actually get some long-term funding. Their short-term working capital, again, I'm sure they will most probably finance it through commercial papers. Was overdraft rates currently a bit expensive. But depending on the currency that they actually get the convertible loan at, will now determine the future impact on them. Because currently the Kenya shilling is where it is because of the stranglehold the central bank has on it. When the central bank loses strength and they start loosening the grip, and the shilling actually becomes volatile again, then if they're holding a foreign currency denominated loan, then it will have a big impact on their bottom line. If it's a Kenya shilling loan, again, taking a convertible loan currently at the current interest rates, it does not seem currently a bit prudent in terms of expansion. I think they can actually put off expansion for some time until interest rates stabilize and they're sure of the direction of the shilling, so that they know what currency to actually get it and at what interest rate to get the loan.
Another company out with results was Total Kenya. It didn't perform that well. It posted a 96% drop in full year profits, also holding back on that dividend. Did you expect that holdback?
Naturally, no, but we're expecting, like what we've been saying, that we're expecting a reduction in dividends as we go along this year, and a little bit more of reinvesting by companies into their businesses in terms of actually cushioning their cash positions and their balance sheets. And with the regulation that is coming, regulation that has been in the oil industry or in the oil sector, especially on the retail side, it makes it very difficult if you are not making money on the wholesale part or from your other small products and from other avenues, and you're primarily just relying on buying the fuel and retailing it. Now when the prices are now capped, then you now have a problem because you can't pass the full cost if the pricing mechanism is actually not operating well. So likely is what they've said, that this year will actually be a hard year for them. As much as the shilling is stable, but interest rates are still high. If you look at their financing costs, the financing cost went up by close to 70–80%, which is with a major concern as they go forward in the year.